Hi and welcome to another episode of Monday Market Outlook. There are only 4 trading days left for 2022. Merry Christmas to everyone. I hope you've had a great 2022, no? So last week, the PSEI bounced off of the support level that we've identified here at 6,400. Actually, it went down up to around 6,367, around that area before it bounced off. Currently, it's sitting above its 200 EMA here. Will we have a Santa Claus rally this week? Usually, the Santa Claus rally happens after Christmas, around December 26 or 27, and ends at around January 4 or January 5, no? So, do we see a Santa Claus rally happening for the PSEI, which will bring the index up to its resistance of 6,800, no? But if you look at this formation, this could this also be a wedge formation here, right? So are we going to see the PSEI go down and then go up before it breaks out up to 6,800, no? So we'll see. MACD shows signs of strength here. So we'll see if the PSEI is able to sustain that momentum going into the last 4 trading days of the year. Usually, during this time, there's going to be a lot of portfolio rebalancing happening, realizing gains or consolidating some losses, etc. But usually, it's this time of the year when we think about the key insights that happened in 2022 and how we can use these insights to plan our trades for 2023. So for this episode, I'd like to share with you my key insights coming into 2023 to help you strategize your investments for next year, no? So coming into next year, what do we know so far? So insight number 1, next year we know for sure it's still going to be a high interest, high inflation environment. The US Fed is expected to keep peak rates for longer, given the inflation and the US economy still running hot despite Fed rate hikes. The Fed during their last FOMC meeting said that they're going to maintain high interest rates for longer than expected. Right now, the US interest rate is around 4.5 and they're expected to increase it up to around 5 or 5.25 by next year. Meanwhile, here in the Philippines, the interest rate is now at 5.5%. Now, the BSP has said that it will maintain a 100 to 150 basis point spread compared to the US interest rates, no? So, if the US interest rates right now is 4.5, the Philippines is now 5.5, so that's a 100 basis point spread. Next year, if the Fed plans to raise its terminal rate up to around 5.1 or 5.25, expect the BSP to increase interest rates up to 6.5, no? So if the Fed is planning to increase its terminal rate up to 5.1% next year, 5.1 to 5.25, expect the BSP to raise interest rates. Well, assuming there's a 100 basis point spread, no, the BSP rate might peak at 6.5%. So given a high interest rate, high inflation environment, remember, Philippine inflation was at its highest in November at 8%. Now we have every reason to expect that inflation may become higher in December given revenge spending, no? So high interest rate, high inflation environment, what we want to do is to stay defensive, no? These are the sectors that will do well in this kind of an environment next year. So you have your financials, your utilities, and energy, no? And then next would be your consumer staples, industrials, IT, and consumer discretionary, right? So my bets for the PSEI next year would be your defensive stocks right here. So you will have your banks, you'll have your BDOs, Metrobank, PPI. You'll have your energy and your industrials like DMC and SCC. You'll have your conglomerates, given revenge spending and the potential for China reopening. These are going to be the beneficiaries, Ayala Corp and SM. Of course, consumer staples, you have your DNL and Jollibee, no? in a high interest rate environment, like I said in our previous episodes, when you have less money to spend, you you typically go to comfort foods, things like Jollibee. These are your consumer staples, DNL is the supplier of fast food, right? Their Batangas plant will be operational by January. They will benefit greatly from that increased capacity by 2023. So these are my picks for next year, no? So look into each of these graphs. We will look into each of these graphs in the coming weeks and identify some support levels where you can buy into these stocks and slowly accumulate for 2023. Now, in terms of dividend yield also, if we look at these defensive stocks, the dividend yields are not so bad, right? So you have your SCC and DMC being Philippines dividend aristocrats, really, but you still have your Metrobank, your Aboitiz Power, and your DNL, which also gives some decent yields, no? A lot of investors like REITs, no, especially retail investors. So personally, I also have REITs in my portfolio, and my top two REIT picks would be A REIT and C REIT. Now, I think of all the REITs, these REITs show the most potentials, no? But a high interest rate environment isn't really friendly to REITs, no? But if you really want to have REITs for the yield, for the constant yields, look into A REIT and C REIT. They will provide you with the best stability, in these unstable times, no? For our second insight, given the high interest rates, of course, bond yields have never been this attractive for a long time, right? So next year, actually even this year, I've seen a lot of bond offerings from company at giving a yield of around 9% and 10% yields. No, these are really great yields that you can buy, especially this coming first quarter, January, February, and when the BSP raises rates, you will see more attractive bonds coming out into the market. So you may want to diversify your investments from equities into bonds, no? The yields of these bonds are at their most attractive in a very long time. So consider bonds as a good investment for 2023. Now, third insight, the PH market will diverge from the US market. While the US market is expected to go into a recession, the PH market is still healthy. So if you look at the US GDP annual growth rate, it's currently at around 3.2%. It was running hotter than expected, no, 3.2%, while the Philippine GDP growth rate is at 7.6%, right? So our growth prospects for next year is still at around 6 to 7%, even if it was trimmed down. Compare this with the US. From 1.2%, it was trimmed down to 0.5%, and many analysts are saying that the US economy might contract. It might be a negative GDP growth rate next year. So what this means is that the Asian markets and the emerging markets, which include Southeast Asia, which includes Philippines, have potential tailwinds. Southeast Asian regions will become quite attractive for investors, no? Given also the Chinese reopening play, we might need to adopt a different strategy when we're investing in both global and PH markets. Next insight, no? So while the PH market will grow at around 6 to 7% next year, we will still be affected by headwinds in the US markets. Plotting the PH stock market into the stock market cycle, we would probably be here in between the anger and depression stage, right? So the PH markets might trade in a range for most part of 2023. So this is a great time to accumulate stocks before we enter into the hope stage and then slowly rally going into 2024 and 2025. Insight number 5, the US markets is going into a recession. And what this means is that we haven't seen the bottom yet. The S&P is currently trading at around 3,844, right? it has so far been tracking this line that we plotted, no? It has currently bounced from its 3,750 support level. As we mentioned, we might see a gap fill up to 3,900 before it continues downwards into 3,500. The S&P 500 has never bottomed before a recession. So remember, the US economy is still growing. Its GDP is 3.2%, right? So it's still growing. We're not in a recession yet. So when we enter into a likely recession next year, we expect the markets to go down further than this. If we look at the US yield curve, it's already very inverted, no? The 2-year bond is around 4.3% and the 10-year bond is 3.7%. Now, this is what an inverted yield curve means. It means that the short-term bonds have a higher yield than the long-term bonds. This means that the outlook for the US economy is negative, right? So an inverted yield curve usually means that the economy will go into a recession soon, no? So if we look at the past recessions for the S&P 500, no? So let's look into the monthly charts. If we look at the past recessions, no, let's look at the 2008 housing bubble, right? This is the 2008 recession here. Look at the drawdown during that time. From peak to throw, this is around 57%, right? So the S&P went down 57%. The 2001 to 2003 recession, the S&P went down almost 50%, right? Even way back, let's go back to the 1974 recession. This is a 47% drawdown. If we look at where we are in the S&P 500, no, we've only gone down by as much as 27%. So if we are expecting the S&P 500 to go down around 50%, we are looking at a bottom of around 2,400, 2,500 here. So how low can the S&P go? We don't know. It can go down up to 2,400, right? It's currently at around 3,900. So imagine if it goes down to 2,400. This is a major support at the 200 EMA, you know, so it can easily go down there. So what we can do for the US markets, we can look into shorting the market, of course. We can and we can also look at some defensive stocks, no? Of course, industrials, energy are still good place for next year. Some say that that tech stocks have reached their bottom and might see a rebound next year. So who knows? So the first quarter for next year will tell us a better story on where the US markets will be moving forward. Lastly, China has already announced that it will fully reopen by January next year. Now when China came out of this news, we didn't really see a good reaction from the markets. This just means that the market is in a to see is to believe mentality, you know. They want to see it first before they actually believe it, because China has been telling the world that it's going to reopen how many times already, you know. So the Chinese government did say that they were going to fully reopen the Hong Kong and China border by January next year. And this reopening could see a 7.6% increase to its GDP. So the China reopening can bring about an increased demand in commodities, no? So you can also look into commodities as an alternative to equities. Chinese tourists going back to the Philippines will benefit the likes of conglomerates like SM and Ayala Corp. Now, my dark horse for next year would be Bloomberry Resorts, no? When a China reopening happens next year, we can look at Bloomberry Resorts to really perform well, no? It's currently at around 746. Now, if we look at the next resistance levels here, we have 9, we have 10, and we have 1160. I would bet that Bloomberry Resorts can easily reach around 12 pesos if the China reopening comes into full swing. So, those are my key insights coming into 2023. I hope you find them useful. Please like this video and subscribe to this channel for more updates. Happy last trading days for 2022. Good luck on your trades and hope to see you again next year. Bye-bye. Thank you.